Welcome back to Synaptic Dividends. All right, today we're putting medical tech giant Medtronic under the microscope. Look, we know their devices are in hospitals everywhere, but for us dividend investors, there's a much more important question. Is their dividend a healthy choice for our portfolios? Let's dive into the numbers and find out. Okay, first question, and it's always the most important one. How safe is this payout? Before we get excited about growth or history, we got to know if the company is actually earning enough cold, hard cash to cover those dividend checks. And for that, we're going to look at my absolute favorite metric, the free cash flow payout ratio. Now, don't let the name scare you. It's actually super simple. Just think about your own budget. Your free cash flow is like your take-home pay after you've paid all your essential bills. For a company, it's the real cash profit they have left. So this ratio just tells us, hey, what percentage of that leftover cash are they using to pay us, the shareholders? The lower the number, the safer it is. So what's Medtronic's magic number? Right now, it's sitting at 74.8%. And for a big, stable company like this, that's a really comfortable spot to be in. We generally like to see this under 80%, so they're well within the green zone. It means for every dollar of cash they bring in, they're only paying out about 75 cents in dividends. That leaves a nice cushion for them to reinvest in the business or just handle a rainy day. And you know what's even better? This isn't some one-time fluke. Just look at the numbers over the last few years. It's been rock solid and consistent. That kind of stability tells you this dividend is being paid from the business's actual operations, not from taking on debt or some kind of financial wizardry. So when it comes to safety, yeah, we're giving this a big old green check mark. All right, so the dividend is safe. That's box number 1 checked. But what about growth? I mean, a safe dividend is great, but a safe dividend that never grows? Well, that's not really what we're looking for, is it? We want to see a company that's committed to giving us a raise every year. And let me tell you, this is where Medtronic's track record is just, wow. We're talking about 48 consecutive years of dividend growth. 48. That is absolutely incredible. That puts them in that super elite club of dividend aristocrats. It tells you that growing the dividend isn't just a suggestion, it's practically written into their DNA. But, and this is a big but, you have to look at the whole picture. While that history is amazing, the pace of that growth has slowed way down. I mean, look at this. 10 years ago, you were getting a nice, healthy 8% raise every year. Awesome. But over the last year, it's been more like 1.4%. So yes, you're still getting a raise, which is great, but those raises are getting a whole lot smaller. Okay, so it's safe and it's got an incredible history of growth, even if that growth is slowing. But what's the ultimate test? How does it hold up when the world is falling apart? Let's run a little stress test, shall we? Let's look at how Medtronic's dividend performed during the 2 biggest financial crises of our lifetime. And frankly, the results are pretty stunning. Think about it. The 2008 Great Financial Crisis, and then the 2020 global pandemic. These were brutal times for the economy. And what did Medtronic do? They didn't just hold the line. They didn't cut the dividend. They didn't even pause it. They actually increased it right through both crises. And we're not talking about tiny symbolic increases either. In the heart of the 2008 meltdown, they jacked up the dividend by a mind-boggling 50%. 50%. And then during the pandemic, when hospitals were canceling elective procedures, which is Medtronic's bread and butter, they still came through with a solid 7.4% raise. That just screams financial strength and confidence from management. All right, so let's pull all these threads together. We've looked at safety, we've looked at the growth history, and we've put it through the ringer with a crisis stress test. So what's the final verdict? What are the numbers really telling us here? Let's just quickly recap what we found. 1, a safe FCF payout ratio, meaning the dividend is comfortably covered by real cash. 2, a legendary 48-year streak of dividend growth. And 3, it's proven to be incredibly resilient, with increases coming right through the worst economic storms. So when you put it all together, the numbers paint a really clear picture. Medtronic's dividend is reliable, it's well covered, and it is absolutely battle-tested. Now, the trade-off here for an income investor is pretty clear. You're probably not going to get massive growth anymore. But what you get in exchange is that incredible, rock-solid stability. Now remember, the dividend is just one piece of the puzzle. If you want to go deeper and really understand the business behind these numbers, the competitive advantages, the products, the management team, then you've got to check out our long-form analyses over on our main channel, Synaptic Investing.